Is that conservative, sensible, or just complacent?
Well, I think, this is the time where, we got to take stock and try to be prepared for any potential outcomes. I think, as you've been discussing with other guests and as we've seen in the data, there is a lot of potential outcomes that could happen. And I think every day, the number of potential outcomes continues to be wide. And, we want our clients to just be prepared and not necessarily take one big side or one other side, because, as we have seen historically, the different scenarios could play out that if the conflict ends quickly, the market has a historical way to rebound and recover very quickly. So you don't necessarily want to be, placing in a place where you are left out. On the other hand, we could have a very prolonged and sustained damage that could affect growth. And therefore, you also don't want to be extremely bullish. So this is one where, it's better to be well diversified, but at the same time, be very conservative and very, very risk control in order for you to be prepared for any potential outcomes that may come out of this.
Before we get into how you do that, can you give us the sentiment check? You've got a ton of clients. Do you sense that the fear of missing out on gains is greater than the fear of losses right now?
Right now, they're in the loss aversion, and the risk aversion has been increasing dramatically for the last, 2 or 3 weeks. So clients, started to just, be concerned about, what would be the length of these, the implications. And in many cases, they see it not just because of the results and the volatility we see on an every given day, but they also see in their regular lives, the effect on gas prices, the effects of just the potential inflation hit, something that, clients are starting to feel. And that's the natural reaction, is to just become, risk averse. So the risk aversion is definitely there. The sentiment towards being uncertain is growing higher. You will see days like today where nobody wants to go on a weekend like this with any positions. They will try to just stay flat. And that's probably the right approach, as we go in through the next few days.
You mentioned the word diversification. The fear of 22 and a repeat of 22 is when the correlation between stocks and bonds turns positive, and it's hard to get away from. You get losses in stocks, you get losses in bonds. Where's the diversification right now?
Well, I think if you go for the last 2 days, there's definitely the same feeling that we had back in 2022. And now the big difference in this particular time, unlike 2022, where we were just, coming out of COVID, our economy was not in the best shape. We were better prepared here. So I think in many cases, our current feeling and our current positioning is that the fixed income market seems to be extrapolating fairly aggressive, what the potential implication of inflation might be. Inflation expectations has gone through the roof, not just in the US, but it should probably even more in Europe and in the UK. And then, the market is now going from potentially easing financial conditions and monetary policy being easy to now, pricing in rates that could be, over, 75 basis points in some cases. So that translation has actually gone into the different type of setting, because, right now, we're talking about the implications of inflation, not the implications of economic deceleration. And I think that's the biggest difference. That trade-off between, what is the market pricing it today is a significant inflation hit, is basically what is driving inflation expectations higher and yields higher, whereas, the long-term implications for the economy hasn't been priced in completely. If you actually see that just in the level of downturns that we have had in the market, for an impact of this level, the markets and the general indices are not down as much as you would expect. So the economic backdrop here seems to be giving a little floor for risky assets. Fixed income seems to be, taking a hit first.
Omar, it's a very good point. When do you think we would see potentially investors start to take more on board the fact that this is not just inflationary up front, but this is going to be a long-term economic hit?
Yeah, I think, the longer this conflict, continues, the worse it will get for economic growth. And the GDP progression, we even saw with the discussion on the dot plots at the Fed, as well as just the Jerome Powell's overall, language, was related to the fact that they still see GDP being consistently good. They don't necessarily see yet the effect of consumers. And I think consumption is going to be the driver of this. I think the longer we see this, especially as we get closer to the summer months, that will, get into a place where clearly GDP will be affected. I think, again, in many ways today, the implications of, gas prices being higher, supply chains being disrupted, feels a little bit more like a tariff, hit that we saw last year, and less of the economic situation we have in 2022.
So you
Still,
think the Fed could look through it then, if it's similar to a tariff hit?
That seems to be what is projected. If you just look at the dot plots, just the even updated, they still had one rate cut, in there. Market seems to be, disagreeing with the Fed, saying like, well, there's going to be definitely no cuts here. But overall, the central banks are thinking about that this could go through. We could probably end these results, and then the economy can sustain it. I think the longer the conflict stays, the more difficult will that be.